Welcome to today's Explainer. We've got a truly fascinating setup unfolding in the commodities space right now, specifically silver. Look, three distinct, massive things have happened in literally just the last 24 hours that you absolutely need to know about. We're looking at verified data for today, August 24th, 2026, and we're going to break down exactly what the markets are screaming at us. No rumors here, just cold, hard facts from verified filings and exchange data. We have a ton of ground to cover, and honestly, the urgency in the market right now is palpable. So let's get into it.
Okay, let's dive into this. We are looking at three massive catalysts driving the action today. First, the Fed officially signaling a September rate pause. Second, physical COMEX inventories absolutely plummeting to multi-year lows. And third, the gold-silver ratio flashing a major buy signal that we literally haven't seen since 2020. Any one of these is a big deal on its own, but having all three converge in a 24-hour window, yeah, that's exactly why we need to unpack this data right now. Section 1. Macro wins. The Federal Reserve and real yields.
To really wrap our heads around what's happening, we've got to start with that 30,000-foot macro view. The winds are shifting, guys. Following yesterday's July FOMC minutes, which, by the way, you can verify straight on federalreserve.gov, market sentiment has just pivoted massively. 72%. That is the probability of a rate pause currently being priced in for September, straight from CME FedWatch. The market is looking at the Fed's internal debate and confidently betting they're going to take a breather next month. That is a massive shift, and it completely sets the stage for everything else we're going over today.
So you might be wondering, why does a 72% probability of a rate pause actually matter for silver? Well, historically, a Fed pause weakens the US dollar. And since silver is a dollar-denominated asset, they have an inverse relationship. Basically, a weaker dollar directly translates to higher silver prices, because it takes more of those weakened dollars to buy the exact same ounce of silver. Makes sense, right?
But wait, the dollar is really only half of the macro equation. The other half? Real yields. The 10-year TIPS yield just dropped to 1.82%. For a little context, that's down from 1.91% just last week. This is absolutely crucial because when real yields fall, non-yielding assets, like silver, become historically way more attractive to hold than government bonds. And this isn't just some wild theory. This is a 40-year historical correlation playing out in real time right in front of us.
Section 2. The squeeze. Physical supply versus record demand.
Let's move down the funnel from that big picture macro environment to the actual physical market, because this is where the story gets incredibly compelling. We're looking at a classic squeeze, constrained physical supply just slamming into record demand. The Silver Institute just reported a massive 15% jump in industrial demand this year alone, driven heavily by solar panels and EVs. But to grasp just how tight supply really is, look at the CME Group Daily Warehouse Report. Registered silver inventories just dropped by another 1.2 million ounces this week. Because of this massive, relentless drawdown, we're now sitting at multi-year lows for COMEX physical inventories. So picture this, a 15% spike in industrial demand eating directly into a rapidly shrinking stockpile. Naturally, this crazy supply and demand imbalance creates a really firm price floor. Because inventories are scraped so low, every single dip below the $34 mark has been aggressively bought up by the market. And that brings us right to this morning's LBMA fix, which came in at exactly $34.82, up 41 cents. The physical squeeze isn't just theoretical, it is actively manifesting in the daily price action.
Section 3. The valuation gap. The gold-silver ratio catch-up trade.
So, with the macro winds blowing in silver's favor and physical supply shrinking, institutional money is hunting for the best way to play this. And they're zeroing in on the valuation gap, setting up a massive institutional catch-up trade. Right now, the gold-silver ratio is sitting pretty high at 84.2. Basically, it takes just over 84 ounces of silver to buy a single ounce of gold today. By historical standards, that number is incredibly elevated, which is a giant flashing sign to institutional traders that silver is severely lagging behind gold's performance. And this brilliantly illustrates the disconnect. When you put our current ratio of 84.2 up against the 5-year average of 72, the undervaluation is just obvious. We are way, way out of balance with recent historical norms. Silver is undeniably undervalued compared to gold at this exact moment, and if there's one thing markets love to do, it's revert to the mean. Let's just do the simple math on what a reversion actually looks like. If the gold-silver ratio simply reverts to 75, which, by the way, is still above the 5-year average, and gold just holds its current price levels, silver would mathematically have to hit $38.50 an ounce. That represents a clean, immediate 10% upside from today's LBMA fix.
This exact math right here is why we are currently seeing hedge funds aggressively rotating their capital into silver miners. It's just a plain and simple catch-up trade.
Section 4. Stock Movers. Today's SEC and TSX filings. All right, let's see how all this builds into actionable market moves today. When the underlying commodity moves, the miners leverage that move, right? But you've got to pick the right specific companies based strictly on verified regulatory filings. Here is exactly how the individual stocks are shaking out. Our clear winner is Endeavour Silver, ticker ESK. They're up 4.7% pre-market. The catalyst? Well, they just filed an updated resource estimate showing 22% higher silver equivalent ounces at their Terranair project. That is a legitimate, foundational fundamental upgrade. On the flip side, our loser today is First Majestic, ticker AG, down 3.2%. According to the TSX regulatory feed, they've had to suspend milling at San Dimas for 15 days because of a water dispute with Mexico's environmental agency. That's a real, tangible operational risk dragging them down. And then we have the safe play, Pan American Silver, ticker PAAS. BMO actually upgraded them to an outperform rating this morning with a price target of $28.50. Because their operations are U.S. domiciled, they offer much lower peso exposure, which gives investors a lower risk profile with some really solid upside.
Section 5. The Playbook. Actionable strategies and key levels.
Now that we understand the macro setup, the supply crunch, the valuation gap, and the specific stock catalysts, it is time to build out a strategy so you can figure out exactly how this fits into your own personal playbook. Matching this verified data to specific investor profiles gives us some really clear strategies. If you're a core holder, your move is steady. Hold your physical silver or your safe plays like PAS and look to buy any pullbacks down to the $34.20 level. If you're a tactical trader hunting for momentum, the data points to going long on Endeavour Silver, ESK, based on that massive resource upgrade, but definitely protect yourself with a strict stop loss at $6.15. And if you're an income seeker, the volatility around First Majestic is actually creating a unique opportunity. Because of their milling suspension, the implied volatility is over 55% right now. That means the premiums on covered calls are incredibly fat today. Regardless of your specific strategy, these are the key technical levels every single trader needs to be watching like a hawk over the next 48 hours. We have established really strong support at $34.20. On the upside, resistance is sitting right at $35.10. Now, if we see a daily close breakthrough and actually hold above that $35.10 resistance line, the technical chart suggests we run straight toward the $36.00 target. But look, we always have to acknowledge reality and the potential risks that could flip this entire thesis upside down. First, regarding the miners, you have to watch to see if that Mexico water dispute at San Dimas spreads to other operations. Keep a very close eye on any announcements from Profepa, Mexico's Environmental Protection Agency. But more importantly for the broader market, we have PCE inflation data dropping this Friday. This is a massive if-then scenario. If that PCE data comes in hot, showing inflation isn't cooling, well, that 72% probability of a Fed pause entirely collapses. And if the Fed pause narrative collapses, literally everything we just discussed about the weaker dollar and falling real yields, it reverses immediately. The data is clear, the catalysts are verified, and the key levels are mapped out. The squeeze is on, but those macro risks on Friday are looming pretty large. This is an absolute trader's market right now, which means you need to do your research and have your entry orders ready to go. So I'll leave you with this final critical question to think about. How are you positioning your portfolio for the next 48 critical hours? Set your alerts, watch those resistance levels, and get prepared for the volatility ahead.